Most people think wealth is built by chasing opportunities. It's an idea that's been sold to us, packaged in thrilling headlines and whispered in online forums. It's the siren song of the modern financial world, promising a fast track to prosperity. We're told to be agile, to be quick, to jump on the next big thing before anyone else. The narrative is one of frantic action, of constant vigilance, a never-ending hunt for that one golden ticket. This chase manifests in a constant anxious cycle fueled by a fear of missing out. It's the late-night scrolling through financial news, the obsessive checking of a stock portfolio, the feeling of panic when a friend mentions a new investment you've never heard of. The pressure is immense. Be first, be fast, or be left behind. We see it in the explosion of new coins. Every day, a new digital token appears, promising to be the next Bitcoin, promising a 1,000-fold return. The stories of overnight millionaires are amplified, creating a powerful illusion that anyone can strike it rich. But for every celebrated winner, there are thousands of silent losers, their savings wiped out by a meme coin that collapses as quickly as it appeared. This isn't investing, it's gambling on digital lottery tickets, driven by hype and social media momentum, not by any underlying value or utility. We see it in the frenzy around new stocks. A company with a catchy story or a charismatic CEO becomes the talk of the town. Its stock price detaches from reality, soaring on pure speculation. The gamification of trading through slick, user-friendly apps encourages this herd behavior, making it feel more like a video game than a serious financial decision. People pile in, not because they've studied the company's balance sheet or understand its long-term strategy, but because everyone else is doing it. They're chasing the price, not investing in the business. And we see it in the relentless pursuit of new trends. Whether it's artificial intelligence, clean energy, or the metaverse, a powerful narrative takes hold, suggesting that this one trend will change everything. Capital floods in, creating bubbles that lift all companies in the sector, regardless of their quality. Chasing the trend means buying at the peak of excitement, often just before the inevitable correction when the hype dies down and the market begins to differentiate between the true innovators and the pretenders. But that mindset, this constant reactive chase, is exactly why most people stay stuck. It's a recipe for buying high and selling low. It's emotionally exhausting and financially ruinous. It keeps you trapped in a cycle of anxiety and regret, always feeling like you're one step behind. You're playing a game where the rules are designed for you to lose, a game orchestrated by those who understand the real secret to building lasting wealth. Because smart money doesn't chase opportunity, smart money positions. This isn't just a clever turn of phrase, it's a fundamental paradigm shift. Chasing is reactive, positioning is proactive. Chasing is about speed, positioning is about patience. Chasing is about capturing a fleeting moment. Positioning is about capturing a long-term, structural shift. Think of it like chess. The amateur player reacts to their opponent's last move, always on the defensive. The grandmaster thinks 10 moves ahead, placing their pieces in positions that will become powerful later in the game. They aren't chasing the opponent's king, they are building an inescapable structure of pressure. That is positioning. And positioning doesn't happen when headlines are loud. It happens when nobody is paying attention. The greatest opportunities are not found in the spotlight. They are cultivated in the shadows, during periods of boredom, fear, or neglect. Smart money acts when assets are undervalued, when a sector is out of favor, when the general public is pessimistic, or even better, completely indifferent. They are buying fear when others are panic selling. They are buying boredom when others are chasing excitement. They are doing the difficult, unglamorous work of research and analysis while the rest of the market is distracted by the noise of the day. Consider Warren Buffett's investment in American Express in the 1960s. After the salad oil scandal, the market believed the company was facing bankruptcy. Panic was rampant. The headlines were deafeningly negative. But Buffett didn't listen to the noise. He went to restaurants and observed that people were still using their American Express cards and traveler's checks. He did the quiet, on-the-ground research. He saw that the company's fundamental business was sound, despite the scandal. He positioned himself, investing heavily when the stock was decimated. He didn't chase a hot trend, he bought a great business when it was hated. The rest is history. That is positioning. This principle is timeless. It applies to every market and every era. And right now, as the world grapples with immense technological, demographic, and geopolitical shifts, the smart money is quietly getting into position for the next decade. They are not betting on the next quarter's earnings report. They are analyzing the deep, structural currents that will shape our world in 2030 and beyond. In this video, we're going to break down how smart money is positioning for the next 10 years, not the next 10 days. We will explore the unglamorous, overlooked sectors where real value is being cultivated. We will examine the psychological discipline required to ignore the crowd and act with conviction. And we will reveal why the very forces that create panic and confusion for most people are the same forces that create generational opportunities for the few who are prepared. We're going to show you how to stop chasing and start positioning, because what's coming will not wait for you to be ready. Most people are trained to think short-term. It's not entirely their fault. We are living in an age of information overload, a constant digital torrent that shortens our attention spans and conditions us for instant gratification. Our brains are hardwired to react to immediate threats and opportunities, a survival mechanism that served our ancestors well on the savannah but proves disastrous in modern financial markets. This instinct is now exploited by a financial media ecosystem that thrives on urgency and fear, and by trading platforms designed to feel more like a game than a long-term investment strategy. Every notification, every price alert, every breaking news headline is a dopamine hit, reinforcing a cycle of reactive, high-frequency decision-making. This creates a dangerous illusion of control, making investors feel like active participants when, in reality, they are often just reacting to market noise. They check prices daily, sometimes hourly. Their mood for the day is dictated by the green or red arrows on their screen. They react emotionally, selling in a panic during a downturn or buying into a frenzy at the peak of a bubble, driven by the fear of missing out. This is the classic cycle of the retail investor. Buy high, sell low. Instead of building a framework of understanding, they outsource their thinking. They follow influencers instead of fundamentals. They chase narratives spun on social media, mistaking charisma for expertise and viral trends for sound investment theses. This approach is akin to navigating a storm by listening to the loudest thunderclap instead of reading the barometer and observing the clouds. It's a strategy based on reaction, not anticipation. Smart money, on the other hand, understands that the real drivers of wealth are not found in the daily chatter. They cultivate the discipline to ignore the noise. They know that the market's daily fluctuations are largely random, a chaotic dance of fear and greed that offers little signal about the future. Instead of being swayed by the market's mood, they operate from a detached, analytical perspective. Their focus is not on predicting the next 24 hours, but on understanding the next 10 years. This requires a profound shift in mindset, from that of a gambler to that of a historian and a strategist. They are not looking for hot tips. They are looking for deep, structural trends. They care about the powerful, slow-moving forces that shape economies and societies over decades. These are the tectonic plates of the financial world. While everyone else is watching the waves on the surface, they are mapping the deep ocean currents. Let's break down what they focus on. First, demographics. The age structure of a population is its economic destiny. A country with a large, young, and growing workforce has a natural tailwind for consumption and growth. Think of post-war America or China in the 1990s. Conversely, a nation with an aging population and a shrinking workforce faces immense headwinds, from rising healthcare costs to a smaller consumer base. These are not sudden events. They are predictable trends unfolding over generations. By understanding where a country is in its demographic life cycle, you can make informed predictions about its long-term economic potential, its housing market, and its sovereign debt sustainability. Second, debt cycles. Economies breathe through cycles of credit expansion and contraction. There are short-term business cycles that last 5 to 10 years, which most people are familiar with, but beneath them are long-term debt cycles that span 50 to 75 years. These begin with low debt and high productivity, evolve into a debt-fueled boom where asset prices inflate, and ultimately end in a painful deleveraging when the debt burden becomes unsustainable. The 1930s and the period after 2008 are classic examples of the end of a long-term debt cycle. Knowing where we are in this grand cycle is crucial for understanding asset valuations and the risk of systemic crisis. Third, technology adoption. Technological revolutions, from the printing press to the internet to artificial intelligence, are the most powerful forces for wealth creation and destruction. These shifts don't happen overnight. They follow a predictable S-curve of adoption. A slow start with early innovators, a rapid acceleration as the technology goes mainstream, and a leveling off as the market becomes saturated. Smart money doesn't just chase the latest tech buzzword. They analyze where a transformative technology is on that S-curve. Are we in the early high-risk, high-reward phase? Or are we in the rapid growth phase where new industries are being built? Investing in the internet in 1995 was a very different proposition than investing in 2005. Understanding this pattern separates speculation from strategic investment. Fourth, monetary policy. The actions of central banks are the invisible hand guiding modern economies. Their decisions on interest rates and money supply dictate the cost of capital, influence asset prices, and can either fuel a boom or trigger a recession. For decades, we lived in an era of falling interest rates, which acted as a massive tailwind for stocks and real estate. That era is now over. Understanding the new policy regime, whether it's fighting inflation, managing massive government debt, or introducing new digital currencies, is non-negotiable. The policy choices made in Washington, Frankfurt, and Beijing will set the rules of the game for every investor for the next decade. And finally, and perhaps most importantly, human behavior. Markets are not just spreadsheets and charts. They are complex systems driven by collective human psychology. Greed, fear, herd mentality, and cognitive biases are constants throughout history. Smart money studies these patterns not to predict them perfectly, but to recognize them when they appear. They understand that the point of maximum financial opportunity is often the point of maximum pessimism. They have the emotional fortitude to buy when others are panic selling and to take profits when the crowd is euphoric. They don't try to outsmart the market. They try to outbehave everyone else. These forces, demographics, debt, technology, policy, and behavior, move slowly, almost imperceptibly, like the shifting of continents. But when they move, they change everything. They create and destroy industries, reshape global power dynamics, and determine the long-term winners and losers. They are the macro framework that provides context for every micro decision. And if you don't understand them, you are navigating the future with a blindfold on. You will consistently misinterpret the present, be surprised by the future, and always be late to the most important shifts of our time. Right now, the world is dealing with three massive forces at the same time: record global debt, rapid technological acceleration, loss of trust in traditional systems. These forces don't create chaos. They create reshuffling. Money doesn't disappear. It moves. Smart money follows where it's going next. To truly understand the landscape of modern wealth, we must look past the headlines and focus on the foundational mechanism that powers the global economy. It's a concept so fundamental, yet often overlooked. Every major currency today is backed by debt. This wasn't always the case. For much of modern history, currencies were tethered to a physical asset, most notably gold. Under the Bretton Woods system established in 1944, the US dollar was convertible to gold at a fixed rate, and other currencies were pegged to the dollar. This created a stable, predictable system. But in 1971, that link was severed. The world entered the era of fiat currency, money that has value simply because a government declares it does. Its value is derived not from a tangible commodity, but from the full faith and credit of the government that issues it. In essence, each dollar, euro, or yen in your pocket is a form of IOU, a claim on a promise made by a national government. And how do governments operate within this system? They borrow to function. From infrastructure and defense to social programs and public services, governments issue bonds, which are promises to pay back borrowed money with interest. Central banks, in turn, often facilitate this process. They can create new money to buy these government bonds, a process known as quantitative easing, effectively printing money to sustain economic growth and manage interest rates. This creates a symbiotic, yet precarious cycle. Governments need to spend, so they borrow. To facilitate that borrowing, central banks ensure there is enough money or liquidity in the system. Now, it's crucial to understand that debt itself isn't the problem. In fact, it is a vital tool for progress. A family takes on a mortgage to buy a home. A student takes a loan for an education. A business borrows to build a new factory and create jobs. This is productive debt, an investment that is expected to generate future income or value greater than the loan itself. On a national scale, borrowing to build a new highway system or fund a breakthrough in medical research can yield immense long-term benefits for society. The problem is scale. And more specifically, the relationship between the scale of debt and the scale of economic output. When debt is used unproductively, to fund consumption rather than investment, or to cover recurring deficits without a plan for repayment, it becomes a drag on the economy. The sheer volume of global debt has exploded in the 21st century, far outpacing the growth of the real economy that is supposed to support it. We are borrowing from the future at an unprecedented rate. This imbalance has a direct and personal consequence for every one of us. When debt grows faster than productivity, the supply of money increases without a corresponding increase in the goods and services available. This is the classic recipe for inflation. Each unit of currency loses purchasing power over time. The dollar in your savings account today will not buy as much in 10 years as it does now. This isn't a bug in the system. It is a feature of a debt-based fiat currency system. A slow, steady erosion of value is the price of economic flexibility. Smart money understands this. The most sophisticated investors, family offices, and institutions don't see this slow erosion of currency value as a crisis to be feared, but as a fundamental rule of the game to be navigated. They don't fight the current. They build a vessel designed to sail with it. They recognize that holding large amounts of cash over the long term is a guaranteed loss of purchasing power. Their primary objective, therefore, is not just to make money, but to preserve and grow their wealth in real terms, after accounting for the silent tax of inflation. That's why they look for specific characteristics in the assets they choose to hold for the long term. Their strategy is a deliberate defense against currency debasement. They are searching for assets that have intrinsic properties that cash lacks. First, they seek scarce assets. These are things whose supply is inherently limited, either by nature or by design. Gold is a classic example. Its total quantity on Earth is finite and it is difficult to mine. Fine art from a renowned master, prime real estate in a world-class city, or even certain digital assets with a fixed supply cap. Their value is underpinned by the simple fact that you cannot easily create more of them. While central banks can print trillions of dollars with a keystroke, they cannot print another Mona Lisa or another block of waterfront property in Manhattan. This scarcity provides a powerful hedge against an expanding money supply. Second, they prioritize productive assets. These are assets that generate their own income or cash flow. Think of owning a share in a profitable company. That company sells goods or services, earns revenue, and distributes a portion of its profits to you as a dividend. Or consider an apartment building that you rent out. It produces a steady stream of rental income each month. Unlike a pile of cash that just sits there, a productive asset works for you. It has the ability to grow its own earnings over time, often at a rate that can outpace inflation, providing both income and capital appreciation. And third, they look for assets that benefit from inflation. While inflation erodes the value of cash, it can actually boost the nominal value of certain real assets. Real estate is a prime example. As the cost of labor and materials to build a new house goes up, the value of existing houses tends to rise as well. Landlords can often increase rents to keep pace with inflation. The same applies to commodities. The price of oil, copper, and agricultural products is quoted in dollars. So, as the value of the dollar falls, it takes more dollars to buy the same barrel of oil or bushel of wheat. These assets act as a natural store of value when the currency itself is weakening. Understanding this framework, the nature of debt-based money, and the strategic response of seeking scarce, productive, and inflation-hedged assets is not just an academic exercise. It is the fundamental starting point for building lasting wealth. This is where long-term investing begins. Cash feels safe. But safety is an illusion when inflation exists. You don't lose money overnight holding cash. You lose it quietly. Smart money doesn't hold cash long-term. They deploy it strategically. Cash is a tool, not a destination. Bitcoin isn't about price. It's about rules. Fixed supply. No central authority. Transparent system. That's why institutions don't treat Bitcoin like a gamble. They treat it like digital scarcity hedge against currency debasement, long-term asymmetric exposure. Smart money doesn't need Bitcoin to replace everything. They just need it to exist. Altcoins are not stores of value. They are technology bets. Some will change industries. Most will fail. Smart money approaches altcoins with smaller allocations, longer timelines, strong fundamentals. Only retail investors usually do the opposite, and that's why they get wiped out. Despite everything happening, stocks still matter. Ownership in productive companies has always built wealth over time. Smart money focuses on cash flow, strong balance sheets, long-term growth, pricing power. They don't chase hype, they buy businesses. Every major wealth shift in history came from technology: printing press, electricity, internet. Today, AI, automation, blockchain, data infrastructure. Smart money positions early, not emotionally. They ask, does this scale over 10 years? Not, is this pumping today? Markets are emotional machines. Fear and greed repeat forever. Smart money understands psychology better than charts. They buy when confidence is low. They sell when euphoria is high. They never panic because they planned ahead. Time is the real advantage. Compounding doesn't feel exciting at first. Then suddenly, it feels unstoppable. Most people quit before compounding starts. Smart money stays. A simple approach smart investors follow: diversification across asset classes, consistent investing, risk management, long time horizons. You don't need perfection, you need discipline. Information is everywhere. Understanding is rare. Smart money studies cycles, history, and behavior. That's why they win long-term. Wealth isn't built loudly. It's built quietly by people who understand how systems work. If you think long-term, stay disciplined, and avoid emotional decisions, time works for you. Most people won't be ready for the next decade, but you can be.